Right now, in the 47 seconds since you clicked this video, global industry has consumed 1,200 ounces of silver. By the time this video ends, another 30,000 ounces will vanish forever into solar panels, smartphones, and electric vehicles that will never give that silver back. We have exactly 73 days of silver inventory left on the COMEX. 73 days. That's the buffer between industrial civilization and complete supply shock. And 3 governments are already quietly stockpiling. This metal is about to break the global economy. Every solar panel on every rooftop from California to Germany. Every electric vehicle rolling off Tesla's production lines in Shanghai. Every 5G tower going up across 3 continents. They all need one thing: silver. And we're running out. Not in 50 years. Not in a decade. Right now. In the next 22 minutes, I'm going to show you the 4-stage pattern that's played out across every commodity crisis in human history. Oil in the 70s that brought America to its knees. Wheat during the Irish famine that killed 1 million people. Palladium in the 2000s that went up 600% in 4 years. And prove to you with public data you can verify yourself that silver just entered stage 3. The outcome is mathematically inevitable. Let's start with the numbers that should terrify every government on Earth. Global silver inventories on exchanges down 85% in 5 years. Solar panel demand by 2026, 200 million ounces annually, up from 85 million in 2020. Industrial consumption doubling while supply stays flat. But silver isn't just industrial. It's also money. For 5,000 years, it's the only commodity that's simultaneously an irreplaceable industrial input and a monetary metal with millennia of trust. When exploding demand hits a monetary system built on infinite debt, you don't get a price adjustment. You get panic. Now, before you think this is clickbait, let me be clear. This is not prediction. This is pattern recognition. There's a 4-stage mechanism that governs every commodity supercycle in history. Silver is now in stage 3. The outcome isn't uncertain. It's mathematically inevitable. Here's how it works, and here's how I'm going to prove it to you 3 times using 3 completely different historical moments. When you see it, you can't unsee it. Stage 1. Abundant supply creates complacency. From 1945 to 1970, oil was cheap. $3 a barrel, 30 cents for gasoline. The entire post-war economic boom assumed infinite cheap energy. No one worried about supply. No one explored aggressively. The system assumed supply would always meet demand. America consumed oil like it was infinite. Suburban sprawl, gas-guzzling cars, industrial expansion. Energy was so cheap, it wasn't even a consideration in business planning. Stage 2. Demand surges, but supply can't respond. Europe rebuilt from the war. Suburbanization exploded. Car ownership soared from 40 million vehicles in 1950 to 120 million by 1970. But here's the critical moment. U.S. oil production peaked in 1970. America became a net importer overnight. New supply was years away. The North Sea wouldn't come online until the late 70s. Alaska was a decade out. Geology doesn't care about demand forecasts. Stage 3. Recognition of structural deficit. October 1973. Yom Kippur War. OPEC embargo. But here's what most people misunderstand. The embargo wasn't the cause. It was the trigger that revealed the brutal reality. Cheap energy was over forever. Oil prices quadrupled in weeks. Gas lines formed overnight. Odd-even license plate rationing. Speed limits dropped to 55 miles per hour. Industrial production slowed. The most powerful country on Earth brought to its knees by the simple math of supply and demand. Stage 4. Price dislocation and panic. Oil went from $3 to $35 a barrel by 1980. 10 times in a decade. Inflation ravaged the economy. Interest rates hit 20%. Central banks lost control. Unemployment soared to 10%. The stock market crashed 45%. 2 recessions in 8 years. The entire economic model of the post-war era shattered. Pattern confirmed. Stage 1. Complacency. Ireland's 8 million people depended entirely on potatoes. Cheap, abundant, taken for granted. 1/3 of the population lived almost exclusively on potatoes. Wheat was unnecessary. The poor couldn't afford it anyway. Stage 2. Supply shock. 1845. Potato blight from North America spreads across Ireland in weeks. 40% of the crop destroyed in one season. But this wasn't just a bad harvest. The blight would return year after year. Stage 3. Recognition of collapse. By 1846, the British government understood this was a multi-year catastrophe. But here's the twist. Wheat was available. Grain existed in British warehouses. But prices spiked so violently that the poor couldn't afford it. Physical shortage created price dislocation so extreme that available supply became inaccessible. Food riots erupted. Workhouses overflowed. Ships loaded with grain continued to leave Ireland for Britain while people starved. The market didn't fail because there was no food. It failed because price destroyed purchasing power faster than relief could arrive. Stage 4. Collapse. 1 million dead. 2 million fled to America. Ireland's population collapsed 25%. Wheat prices stayed elevated for years. Entire counties emptied. The social fabric disintegrated. Remember that lesson. When supply shock meets inelastic demand, available supply can become inaccessible through price. More recent. More financial. Stage 1. Complacency. Throughout the 90s, palladium was cheap, boring, ignored by investors. Few people even knew what it was. Industrial use was limited. No one cared about supply chains. Stage 2. Demand explosion. Early 2000s. Environmental regulations tightened globally. Palladium became the preferred catalyst for gasoline engines. Cleaner burning. More efficient than platinum. Automotive demand surged. Problem? Palladium is almost entirely a byproduct of nickel and platinum mining. You can't just mine more palladium. Supply is structurally inelastic. Stage 3. Deficit recognition. By 2019, 8 consecutive years of deficit. Automotive demand consumed more than mines could produce. Inventories vanished. Russia supplied 40% of global production with no incentive to flood the market. Paper contracts tried to manage the shortage. But physical markets decoupled. Industrial users started hoarding. Automakers panicked. Stage 4. Price explosion. $500 an ounce in 2016. $3,000 by 2021. 6 times in 5 years. Ford, GM, Toyota scrambling to secure supply. Production lines threatened. The only solution was substitution. Automakers switched back to platinum at massive cost and efficiency loss. Billions spent retooling factories. Years of research wasted. When physical supply can't meet industrial demand, price is the only adjustment mechanism, and it's never smooth. It's violent. Now let's apply this exact mechanism to silver. For 40 years, silver has been absurdly cheap. In inflation-adjusted terms, silver today costs less than in 1980. Think about that. 45 years of monetary expansion, industrial growth, tech revolution, population doubling, and silver is cheaper. Why? Decades of supply exceeding demand. Massive deposits were developed in the 80s and 90s. Mexico, Peru, China ramped up production. Governments sold reserves. The U.S. Treasury dumped billions of ounces. China liquidated strategic stockpiles. Everyone treated silver as a boring industrial commodity. No one worried about running out. Mining companies focused on gold, copper, zinc. Silver was just the byproduct. The bonus. Complacency was total. Wall Street created paper derivatives, futures contracts, ETFs backed by promises, not metal. The paper market grew to 100 times larger than physical. No one questioned whether the silver actually existed. No one demanded delivery. 40 years of taking abundance for granted. In 2010, solar installations were negligible. Today, solar is the fastest growing energy source globally. Every crystalline silicon panel requires silver paste for conductivity. The front contacts, the bus bars. No substitute matches silver's efficiency. Copper oxidizes. Aluminum doesn't conduct well enough. Silver is 95% reflective. Perfect thermal conductivity. The math is brutal. Every megawatt of solar capacity needs approximately 20 grams of silver. The International Energy Agency projects 400+ gigawatts of solar installations annually by 2025. That's 200 million ounces per year for solar alone. Add electric vehicles. They use twice the silver of gasoline cars. Advanced electronics, battery management systems, charging infrastructure. Add 5G infrastructure. Every tower, every small cell, every fiber optic connection. Add medical devices where silver's antibacterial properties are irreplaceable. Surgical instruments, wound dressings, medical electronics. Total industrial demand: 1 billion ounces per year by 2025. Now, here's the supply problem. Global mine production peaked at 880 million ounces in 2015. Since then, flat to declining. Why? 70% of silver comes as a byproduct of zinc, lead, and copper mining. You can't just mine more silver. You have to mine base metals and hope silver comes with it. Base metal prices have been choppy for a decade. Mining companies cut capital expenditures to multi-decade lows. No new mines, no exploration, no investment. The few primary silver mines that exist are getting deeper, more expensive to operate. Ore grades are declining globally. The easy silver is gone. Energy costs for mining have tripled. Labor costs rising. Environmental permits taking years. Supply is not just inelastic, it's declining. Demand is not just growing, it's accelerating exponentially. The gap widens every month. We are here right now. This is happening in real time. In 2020, the COMEX had 400 million ounces of registered silver available for immediate delivery. Today, under 40 million ounces. 40 million ounces equals less than 2 weeks of global consumption. The London Bullion Market Association reports similar depletion. Shanghai Futures Exchange inventories at multi-year lows. The Silver Institute confirms 4 consecutive years of deficit. 800 million ounces consumed. 750 million ounces produced. 50 million ounce annual deficit. And it's accelerating. Physical premiums are rising everywhere. In London, $2 over spot. In New York, $3 over spot. In Asia, $4 to $5 over spot. Delivery times extending from days to weeks to months. Coin and bar dealers reporting allocation problems. Industrial users are stockpiling because they see what's coming. Apple secured a 3-year silver supply contract. Tesla locked in 5-year agreements. Solar manufacturers building strategic reserves. This isn't temporary tightness. This is structural, multi-year supply crisis with no solution. The paper market is losing control. 100 ounces of paper silver are traded for every ounce of physical metal. But when delivery time comes, the silver isn't there. Contract holders are forced into cash settlement. The disconnect between paper price and physical reality is widening. March 2021, Silver ETF, SLV, couldn't source physical silver for 2 weeks. June 2022, COMEX changed delivery rules to prevent a squeeze. October 2023, 3 major refineries stopped taking new orders. The system is breaking in real time. Industrial demand is inelastic. Solar companies can't build panels without silver. Electronics manufacturers can't switch materials. Medical device companies can't compromise on performance. They'll pay whatever price is necessary. But investor demand hasn't even started yet. When the broader market recognizes this crisis, when silver becomes an investment theme, when pension funds and sovereign wealth funds start buying, industrial users will compete against trillions in investment capital. That's when the paper market breaks completely. Stage 4 is next. Solar isn't just growing, it's exploding exponentially. China is installing 200 gigawatts annually. The US committed to 1,000 gigawatts by 2035. Europe mandating solar on every new building. India targeting 500 gigawatts by 2030. Silver is absolutely critical to photovoltaic efficiency, the front contact grid that collects electrons. Silver paste screen printed onto silicon wafers. Each panel uses 15 to 20 grams of silver. No material comes close to silver's performance. 99.9% purity required. Perfect conductivity. Oxidation resistance. Temperature stability. Engineers have tried everything. Copper grids corrode within months. Aluminum reduces efficiency by 15%. Carbon contacts fail in heat cycles. Printed electronics can't handle the current density. The physics are unforgiving. Silver or solar doesn't work. Installation rates are accelerating. 2020, 85 million ounces for solar. 2025, 200 million ounces projected. 2030, 350 million ounces needed. That's 40% of current global production for solar alone. Internal combustion engines use minimal silver, maybe half an ounce per vehicle. Electric vehicles need 2 to 3 ounces each. Battery management systems, power electronics, charging systems, thermal management, advanced semiconductors. Global EV sales growing 50% annually. China selling 6 million EVs per year. Tesla targeting 20 million vehicles by 2030. Every major automaker electrifying their fleet. Government mandates eliminating gas cars. Norway by 2025. California by 2035. EU by 2035. China targeting 60% EV market share by 2025. That's 30 million additional ounces annually just for the EV transition. 5G networks require 10 times more cell towers than 4G. Each tower uses 2 to 3 ounces of silver. Antenna systems, power amplifiers, signal processors, fiber optic connections. China installing 600,000 5G base stations annually. US planning 800,000 new small cells. Europe targeting full 5G coverage by 2025. India, Brazil, Southeast Asia following. Rural coverage requires massive infrastructure. Autonomous vehicles need 5G everywhere. Smart cities depend on ubiquitous connectivity. Industrial IoT demands ultra-low latency. The build-out is just beginning. Current estimate: 50 million ounces needed for global 5G infrastructure. That number will double as rural areas get connected. Medical applications growing rapidly. Silver nanoparticles in wound care. Antibacterial coatings on surgical instruments. Medical electronics requiring higher purity. Implantable devices using silver contacts. COVID accelerated medical technology adoption. Electronics miniaturization drives silver demand. Smartphones use more silver per unit as chips get smaller. Higher current density requires better conductivity. 5G chips need silver interconnects. Data centers consuming massive amounts. High-frequency trading systems. Quantum computing research. Defense applications classified but substantial. Aerospace silver demand growing. Satellite constellation launches. Space exploration programs. Each application individually small. Combined, they represent 150 million ounces annually and growing 20% per year. No substitutes meet performance requirements. Critical applications can't compromise. Let me destroy that delusion. Substitution. No substitute for silver in solar maintains efficiency at scale. Copper oxidizes in months. Aluminum reduces power output 15%. Carbon nanotubes cost 100 times more. Graphene still in labs after 20 years. Engineers have spent billions trying. Samsung, Applied Materials, First Solar. Every major solar company. Decades of research. No breakthrough. You cannot engineer around the periodic table. Silver has unique atomic properties. Highest electrical conductivity of any element. Highest thermal conductivity. Most reflective metal. These aren't engineering challenges. They're physics limitations. Recovery rate from electronics below 20%. Too dispersed to be economical. Smartphones contain 0.02 ounces each. Cost more to extract than mine new silver. Solar panels last 25 years. That silver isn't coming back soon. Recycling works for large concentrations. Industrial scrap. Photographic waste is nearly gone. Electronic waste, too diluted. Current recycling. 180 million ounces annually. Demand, 1 billion ounces. Recycling can't close the gap. Mining development takes 7 to 10 years minimum. Exploration. Permitting. Environmental studies. Financing. Construction. We don't have 7 years. The deficit is now. Silver grades declining globally. Best deposits already mined. New discoveries. Smaller, deeper, more expensive. Capital requirements massive. Billions needed per mine. Investors reluctant after commodity bear markets. ESG concerns limit financing. Environmental permits taking longer. Community opposition increasing. Even if mines open, they're mostly byproduct, dependent on zinc, copper, lead demand. Base metals in structural bear markets. Silver mine economics don't justify investment. Primary silver mines barely profitable at current prices. The only way demand falls is if the energy transition stops. Solar mandated by law across Europe, China, United States. Trillions in subsidies committed. Entire industries retooled. This is government policy. national security policy, climate policy, energy independence policy. Policy doesn't care about silver prices. Government mandates don't respond to commodity costs. Too much invested to turn back. Sunk costs in trillions. Political careers depend on delivery. International agreements binding. Paris Climate Accord. Net zero commitments. The transition is inevitable. Silver shortage won't stop it. It will just make it extremely expensive. Go verify this yourself. Don't take my word. COMEX silver inventories. Updated daily at cmegroup.com. Registered silver available for delivery. Silver Institute annual reports. World Silver Survey. Supply and demand data. Government sourced. IEA solar forecast. International Energy Agency. Global Energy Review. Solar PV Technology Roadmap. Mining production data. USGS mineral commodity summaries. Country-by-country breakdown. Silver grades over time. Cross-reference everything. Multiple sources. Government databases. Industry associations. Academic research. When you see the deficit growing, inventories collapsing, demand accelerating, you'll understand. This isn't hype, this is math. Math doesn't care about opinions, politics, hope. Consumption exceeds production. Inventories are depleted. Price must rise. That's the only possible outcome. Silver sits at the intersection of three unstoppable forces. The energy transition consuming silver exponentially. The monetary crisis driving investors to hard assets as fiat currencies debase. The supply crisis with no solution in any time frame that matters. When these converge, and they're converging now, the price won't rise. It will dislocate. Stage 4 looks like this. A major industrial player publicly announces they cannot source enough silver. Solar manufacturer, electronics company, defense contractor. That triggers the cascade. Other firms panic buy. Governments secure supply for strategic industries. Investment demand explodes. The paper market breaks. COMEX changes rules, restricts delivery, forces cash settlement. It's happened before. It will happen again. When physical decouples from paper, when industrial bid meets monetary bid, when solar panic combines with currency crisis, silver won't rise steadily. It will gap to $50, $75, $100. These aren't predictions. These are logical outcomes of supply-demand math in a market with no inventory buffer. Here's my challenge. Look up COMEX silver inventories. Check IEA solar forecasts. Read Silver Institute supply-demand reports. Review mine production data. It's all public, all verifiable. Once you see the pattern, you can't unsee it. What comes next is the largest wealth transfer in commodity markets in 50 years. The people who see the pattern, who understand the machine, who position before stage 4, they'll be on the right side of that transfer. Everyone else will wonder how they missed it. Don't be everyone else.